Hey, welcome back to the deep dive. We're here to basically cut through all that research, all the noise, and give you the key takeaways fast.
Exactly. Get you informed without you needing to read, well, stacks of studies.
Today, we're tackling technical chart patterns.
hmm
Specifically, which ones might actually have the best historical track record for predicting where prices are heading.
Yeah, we've dug into empirical studies, historical data, expert
Yeah,
takes,
right.
the works. The goal is to see which patterns seem to, pop up with the highest success rates historically.
But with some important caveats, right? Always caveats in finance.
Always. So the mission today, identify those promising patterns based on past data, but also talk about, well, the reality checks.
Okay, let's dive in. Chart patterns.
Yeah.
They generally signal one of two things, right?
Yeah.
Either the trend's reversing or it's going to keep going.
Correct. Reversal or continuation. And one of the big names in reversals is the head and shoulders pattern. And it's opposite, the inverse head and shoulders.
Right, the classic head and shoulders. Looks kind of like a profile, doesn't it? Three peaks, middle one's the highest ahead.
Exactly, with shoulders on either side. And when the price breaks below the neckline, that's the support level connecting the lows between the peaks. It often signals a potential move down.
And the inverse is just that flipped, suggesting a move up.
Precisely. Flipped upside down, often seen as a bullish reversal signal after a downtrend.
Okay, now the data here is pretty interesting. That inverse head and shoulders, Bulkowski's research suggests, what, an 89% success rate in bull markets?
Yeah, an 89% success rate for hitting its target after an upward breakout in bull markets, and the average gain was around 45% is quite significant.
Wow, and the standard head and shoulders isn't too shabby either, right?
Yeah.
Around 83% success historically.
Correct, around 83.04% according to some sources tracking its success in predicting downward moves. It suggests a real shift in, market psychology.
Like the balance of power shifting between buyers and sellers.
Exactly. One side is finally overpowering the other. And these tend to show up more reliably in already established trends.
And time frame matters. Daily, weekly charts are better.
Generally considered more reliable, yes. Longer time frames tend to filter out some of the short-term noise.
Okay, let's switch gears. Continuation patterns. The rectangle.
Right, the rectangle. Think of the price just, well, consolidating. It bounces between a clear resistance level on top and a clear support level below, like it's stuck in a box,
So it's pausing.
kind of catching its breath within the existing trend. The idea is that when it finally breaks out of that box, it's likely to continue in the direction it was already going.
And the win rates here are strong too, especially the bullish rectangle.
Bulkowski found an 85% success rate for the rectangle top, which acts as a bullish continuation pattern in bull markets with an average gain of 51%. The bearish rectangle, signaling continuation downwards, also performed well, around 78%.
And I saw some chatter, I think it was at Tech Charts, highlighting rectangles too.
Yes, they've noted rectangles often have very high success rates among the classical patterns, especially what they call type 1 breakouts, the cleaner ones.
So it's like a pressure cooker building momentum inside that range. And these work across different time frames.
They seem pretty robust, yeah. But like most patterns, you often get a bit more reliability from the longer-term charts, like daily or weekly.
Makes sense. We should probably also briefly mention a couple of others with high reported rates, like the double bottom.
Oh, yeah. Double bottoms, looking like a W, showed around 88% success in bull markets in recent data. And triple bottoms, similar but with three troughs, around 87%.
So also very high rates, but maybe studied a bit less consistently than the head and shoulders or rectangles.
Perhaps, yeah. The focus often lands on head and shoulders and rectangles as sort of the textbook examples.
Okay, critical point time, the caveats, these amazing win rates. They're often in bull markets, right?
That's a huge caveat. Market context is everything. A pattern might work brilliantly when everyone's buying, but less so in choppy or bear markets.
And you absolutely need confirmation. Just seeing the shape isn't enough.
Definitely not. You want to see, ideally, a surge in trading volume when the price breaks out of the pattern. That suggests conviction.
Like more people jumping on board.
Exactly. And checking other indicators helps too, like does the RSI or Mansi D support the move? Don't trade in isolation.
And we have to acknowledge false breakouts. They happen.
Oh, absolutely. The price breaks out, looks promising, and then snaps right back into the pattern. Happens all the time. That's why risk management is crucial.
Which also touches on subjectivity, doesn't it? One person's perfect pattern is another's messy chart.
Precisely. Drawing those trend lines, identifying those peaks and troughs, there's often some interpretation involved.
And there was that 2020 study suggesting maybe patterns aren't as effective now. below 50% in their findings.
Right. That study by thefivers.com offered a more skeptical view. It's a reminder that markets evolve, algorithms trade differently, participation changes. What worked historically might become less reliable.
So stop losses are non-negotiable, really.
Absolutely fundamental. No pattern, no matter the historical win rate, justifies betting the farm without a safety net.
Okay, so summing up the top contenders, based purely on the highest reported historical win rates, inverse head and shoulders leads the pack.
Based on that Bulkowski data, especially in bull markets, yes, the inverse head and shoulders showed that remarkable 89% rate.
Followed closely by the rectangle, particularly the bullish version, also showing high reliability and strong potential gains.
Exactly. Those two seem to consistently rank highly in studies focusing on historical performance.
But again, history isn't destiny in the markets.
Not at all. It provides useful context, maybe increases probabilities slightly in your favor if used correctly, but guarantees no way. The market is dynamic.
So for you listening, maybe the takeaway is to explore these patterns, see how they look on the charts you follow. Backtesting tools on platforms like TradingView can be really insightful.
Definitely. See for yourself how they've performed in your specific markets and timeframes. Don't just take the numbers at face value.
And that leads to a final thought to chew on.
Yeah, given that markets change and patterns can sometimes become, well, traps set by bigger players knowing everyone's watching them, what else should you be looking at? What other tools or approaches could you layer on top of these patterns to make truly informed decisions? Something to consider.